Welcome to our 2018 federal budget update. As usual, the GrowthWise team had a wonderful party last night for the federal budget, getting our nerd on and reviewing and reading all of the budget papers overnight. Alan, what did you think?
It was pretty lacklustre in terms of a budget, not any major changes, particularly for small business. A few little tweaks here and there, but I think it's pretty much a let's get this election on the way and let's win for the Liberal Party.
I know, there certainly wasn't a lot for us to comb through in the budget papers that really impact small business or superannuation. All right, so shall we kick off?
Let's do it.
Let's start to have a discussion about businesses. Shall we start there?
Let's do it.
All right, so this year, the instant asset write-off, very exciting. We still get this concession. So last year and for the last couple of years, we've been able to claim a write-off instantly for any assets that cost less than $20,000. Now, it's key to remember here that this is not money in your back pocket. It just means that we get a tax deduction right now, as opposed to having to write something off over a number of years. Really key though, this is not a handout from the government.
Not at all.
In traditional style, small businesses have more red tape. So a few years ago, taxable payments reporting summaries, or however the acronym goes, were introduced that made sure all people in the building and construction industry needed to report payments to contractors. That last year was extended to people in the cleaning and courier industries, and now will be extended to people in security and investigations, as well as road freight transport and computer design, which I found a little bit strange.
Random.
Very random. But this doesn't start till the 1st of July 2019. So this is one of the reasons that we always suggest to people to use something like HubDoc and Xero together, because it really ensures that you have all that fundamental underlying paperwork to keep the end of year summaries very easy to prepare.
Right. We've got Big Brother out there watching, so why not use that software available to help you?
So in another quite random act, the government have made certain payments non-tax deductible. So if you don't actually withhold any withholding tax from wages that you're paying to yourself or to any employees, the actual wages payments are no longer going to be tax deductible. Similarly, if you are paying a contractor who doesn't give you an ABN and you don't withhold tax on the payment to that contractor, that payment is also not going to be tax deductible. So this again is more red tape from the government and really ensuring that you A, have ABNs for all of your contractors and are withholding tax if they're not giving you that ABN, and B, really ensuring that this withholding on wages is actually being paid on an ongoing and regular basis as well. So very random, but again, just some extra red tape. This doesn't start till the 1st of July 2019 though, so we'll wait for the practical fundamentals of how that's actually going to come into play. So lastly, for small businesses, some changes to the R&D tax incentives. Now, the goss before the government was that this was going to be a massive impact on the actual industry, when in fact, for anyone with a turnover less than 20 million, the real change here is that your refund is going to be capped at $4 million. So definitely an impact, but not necessarily the bigger impact that we were expecting. For those with turnovers greater than 20 million, huge changes, but for us, that's none of our current businesses claiming R&D.
That's right.
And now talk to me about what's happening in superannuation.
The land of super. So a few little tweaks and changes that have been announced that are encouraging people to keep contributing to super and planning for their own retirement. So one of the first little tweaks that the government announced was we're allowing self-managed super funds, which previously had a limit of 4 members, to be increased to 6 members. So the idea of a family super fund is being increased to allow the introduction of children into the family fund and being able to pool that money to plan for retirement. We've also had an allowance for those self-managed super funds that have an audit requirement. So the current requirement is that a self-managed super fund must be audited every 12 months before they can lodge their tax return. The government has announced that for people that are doing it right and are getting those clean audit reports, that requirement will be reduced to once every 3 years. So that's a pretty big deal for our self-managed super fund clients.
And that sounds like a reduction in red tape.
I know, right?
Who would have thought?
We've also got a small change for those people that are lucky enough to earn more than $200,000 a year in super. The number is $263,000. You now can elect whether you want your employer to continue to pay super guarantee on such a large amount of money, which is good for people that are lucky enough to earn it, but probably won't affect a lot of everyday Australians. There's also some smaller changes around people that have those smaller superannuation balances. So people that have less than $6,000 in an account will have any fees on those accounts trapped at 3% of their account balance. But it just goes as part of that bigger picture that people should consolidate those super balances and get them all into one fund that's actually working for you for your retirement.
And a ban on exit fees if you want to change super funds.
That's right. So another incentive for people to consolidate their super, you've got the ability now to change without being penalised from a fund for leaving them.
That's definitely exciting.
Finally.
And some changes for younger people and insurance. What's happening there?
Yeah. So you've got an option now to be able to opt out of insurance inside superannuation if you're young and have small balances, so that those insurance premiums that super funds charge you don't erode your actual savings amount, which is a good step forward.
Definitely. And there's some changes for people who have low balances and who are over the age of 64. What's happening there?
That's right. So as part of a bigger picture strategy for helping Australians prepare for their own retirement, the government's removing a current works test so that people that have less than $300,000 in their super fund, when they stop working, have a time period of 12 months to be able to put that extra money into superannuation that they might have got from their final pay from working, put it into super, put it in the right spot so that they've boosted those retirement savings without being penalised for it for not working for the 40 hours in the last 30 days. That restriction's been removed, so you can do it without any penalty.
Which is quite good. And there are two other great changes for older Australians as well, for pensions. Tell me about those.
So people that are working longer, the pension work bonus, so that's allowing you to earn more money when you finally do retire for those people that work past their pension age. So it's an incentive from the government to say, hey, you're still working past your pension age, we're not going to penalise you, we're actually going to encourage you so that you won't lose your pension when you finally stop working.
Which is excellent, and a pension loan scheme as well.
Okay, so this is the example of people that have put all their money into their family home and haven't contributed to super throughout their life to have enough retirement savings when they retire. Having a pension loan scheme means that you're effectively able to tap into the equity inside your home and have that only taken out from the government when that house is sold or when you die.
Which is quite exciting as well.
Which is good because it's going to affect a lot of people that don't have that money in superannuation that really won't be able to survive on the age pension alone if they don't access this. So it's really exciting for older people that they're able to take more control of their equity when they're retired.
Which is excellent. Now, most of the buzz pre the budget and certainly post the budget has been all around the personal income tax cuts. And while we always welcome tax cuts, I do find this quite hilarious because we're talking about one thing that is going to be introduced starting the 1st of July 2018, and that's this new tax offset that's coming into play. And the new tax offset is $200 if you earn less than $37,000 per year, and it's $530 if you earn between $48,000 and $90,000 per year. Now, this is a tax offset. So what that means is it's money that you're going to get at the end of the year once you actually lodge your income tax return. So it's not money that you're getting ongoing in your weekly pay packet. It's just literally a lump sum. So the first you're going to see this is July 2019 if you're lodging your tax return really, really early. So there's one more thing that's changing, and that's that the tax bracket where you pay 32.5 cents in the dollar is moving from a cap of $87,000 to $90,000. So that means for people earning 90 grand a year, you're going to get a whopping $135 extra per year. So all this hype, and that's the tax cuts that we're getting now. Now, the exciting part is by 2022, July 2022, we start to see a lot of the bigger tax cuts coming in that the government is trying to implement. And it'll be really exciting once we get to that stage, but we obviously have to wait to get to that stage. So one more thing, the Medicare levy was supposed to be increasing this year, and it's been decided that it is not, and it's going to remain at 2%. So again, a little bit of exciting news going in there.
Thanks, GoMo.
Thanks. So there's a lot of spending happening in this budget, massive amounts of money for transport, a space program, which is always exciting, and some funding that's been allocated to supercomputers and AI, which we obviously love as well. The Great Barrier Reef's got a stack of funding. There's $140 million over 4 years to attract international investment in film production in Australia. So we should see lots more superstars and famous people coming to Australia. $200 million has been earmarked for GPS technology for farmers, which is actually really exciting as well, because this is going to allow them from an agricultural standpoint to literally get to the millimetre where they should be sowing their seeds to, for soil production and great crop growing, so that they're not having issues year on year when they're producing. And then a whole host of money has been earmarked as well for the SME export hubs. So there's a lot of people who are exporting now overseas that are small businesses, and this is actually quite exciting because it promotes and really fosters that environment to continue to export.
What about all the other little tidbits, like the little sneaky things that they sneak into the budget that they don't give a lot of airtime to, that actually have impact on people ongoing in their everyday life? The
random things is what we're talking about now. So cash payments greater than $10,000 have been outlawed. So part of trying to cut down on this black economy is that if you've got a business and you're providing goods and services, so most of us just selling normal things, even our time, if someone tries to pay you in cash and that invoice is greater than $10,000, naughty, you are not going to be allowed to do that anymore.
EFT it, people.
EFT it. So really cracking down on the cash economy. The ATO have a stack of money again to really stop this cash economy stuff happening. And they've also got a stack of money to keep chasing people who haven't paid, pay-as-you-go, super and GST. So expect to have those phone calls coming in and those letters if you're late with any of those payments. There's also a change to the director penalty regime. So if you've been naughty and you haven't paid your tax and super and you're a company, there's been asset protection in that as a director, you're not personally liable for the GST that you ordinarily would have paid. Now, the ATO are bringing in a new regime where if you haven't lodged and you haven't paid and you're trying to get out of this debt, directors can now be classified as personally liable. So really cracking down on this stuff. Some other random things, if you're a drone enthusiast, there's been nearly $3 million allocated for security and civil aviation stuff, just to make sure that we actually have some additional rules about drones in place. If you're famous, clearly that doesn't yet apply to us, but if you are famous, you are now going to have to pay tax on all of that income in your personal name. So what used to happen is you would assign a right for Alan Spicer, the famous person, and you would allocate that to your company, and your company could then utilise Alan Spicer, name and images and everything that was surrounding you to reduce the tax that you had to pay, because the company obviously was earning that money as opposed to you. So see you later, famous people. The ATO obviously think you should be paying more tax, and you're now going to have to pay tax on all that income in your personal names.
Big Brother's really watching you.
Big Brother is definitely watching you. So one other exciting thing for our friends in the craft brewing industry, there's been some additional relief from excise on the smaller kegs. So this issue's been popping up certainly a lot of late, where there's been a lot of information requesting government to say, all right, let's bring the smaller brewers back in line with the larger brewers. So the excise refund scheme cap is going to be introduced to $100,000
Excellent.
each year, starting from 1st of July 2019. And we're also getting the concessional draft beer rates down to anything over 8 litres in a keg, as opposed to 48 litres in a keg before as well. So some exciting news happening all over the place.
Cheaper beer. Wow.
Cheaper beer and better craft beer as well.
That's right.
All right, so as we said, there's nothing really exciting that you all need to go out and kind of do something today with. Obviously, there's little bits and pieces and different changes in tax rates and the instant asset write-off that's applicable for this year. And that's exciting for people to be able to utilise, but nothing that people need to do today.
That's right.
All right, what has to happen from here for everybody who is super excited about this budget?
Get excited. Get in contact with us. For all of our clients, we start our tax planning now, so that people that will make use of things like topping up their superannuation contributions to the $25,000, thinking about already buying that new asset, maybe bringing that forward to this financial year so that we can make good use of the tax offsets and get yourself well planned for retirement.
And saving tax, right?
Saving tax.
That's the exciting part.
No one likes paying tax.
No one definitely likes paying tax in Australia. All right, so any questions, certainly just post them up on our Facebook page and we'll get back to you. Otherwise, we're off to start getting excited about tax planning for 2018.